Today, I have an incredible business with a great track record of rewarding shareholders. Recently, this stock has been crashing, and I reveal whether it's a buying opportunity or falling knife to avoid. In the last 5 years, the crashing stock has grown its revenue by 66%. In the same time, profits have climbed by 57%, which has meant that profit margins have fallen by nearly 6%. However, when we look at the 10-year trends, revenue has climbed 252%, with profits increasing at a greater pace of 316%, meaning that over the last decade, profit margins have improved by 18%. That said, this stock appears overvalued, as the market capitalization has increased at a greater rate than the profits. So, is this stock really overvalued, and has the crash made it an attractive buying opportunity? After the stock crashed, the business now trades at a price-to-earnings ratio of 12.9 times 2023 earnings. This is much closer to the 52-week low than its 52-week high, although it is still higher than the UK market average of 10.7 times. On the other hand, it is lower than the 5-year average price-to-earnings ratio of 14 times and slightly above the 10-year average of 12.1 times. This might suggest a good value for the stock given its history. Okay, so this stock might appear to be good value, but why are investors selling? Well, the EPS growth over the last 5 years is 71%, which is greater than the revenue growth of 66%. This is due to share buybacks, in which the estimated total shares has fallen by nearly 8% in the same time. However, this has slowed down as the company has gotten bigger, with an EPS growth in the last decade of 375%. Perhaps investors are less confident in the business's future profit growth and therefore have been selling. Now, this could be the reason, but the ROIC is strong with this one at 14.9%. The return on capital employed floats above the 5-year average of 13.8% and remains slightly below the 10-year average of 15.1%, inferring that this is a very consistent and sustainable level of profitability. In fact, if we take into account the pandemic impact, it could be why profit growth had slowed down in the last 5 years versus the last 10. I mentioned earlier that this company participates in share buybacks, which can suppress the equity levels in the business. So are investors selling due to a falling book value? Whilst the book value has been declining consistently over the last decade, it's unlikely that investors are selling solely for that reason. Despite the increase of debt of 85% and the lower equity growth of 66% in the last 5 years, investors appreciate that the debt to equity ratio has remained relatively stable. Sure, it is at a high not seen since 2015, but does sit at a manageable level of 150%. So far, this analysis has been quick. I'm planning to host a workshop on analysing stocks efficiently, so if you'd like to find out more, click the link in the description down below. Although some investors might have concerns over the health of the balance sheet, those investing for more defensive stocks might find that this stock has a very small cash position. Furthermore, the current and quick ratios have worsened in the last 5 years and now sit between 0.9 to around 1 times, meaning if the company is hit by a financial crisis, they may struggle to pay off its short-term liabilities with its liquid assets. So what have we missed, and why are investors selling shares? Well, first quarter results show that revenue is still growing at a fast pace. It's up 19% on 1 year ago and 46% on 2 years ago. Profits do lag slightly in the last year, being up only 13%, but in the last 2 years it's actually outpaced the revenue growth at 47%, again fueling the growth in profit margins. However, the balance sheet has gotten worse, with debt rapidly increasing and equity just not keeping up with the levels of debt. In fact, the net book value has worsened by 3 times in the last 3 years. More recently, however, this stock has posted a trading update. It expressed that due to a lower level of emergency response activity, such as less naturally occurring events like the hurricane season for instance, and the writers and actors strikes, it has meant that revenue and EBITDA are going to be below market expectations, with EBITDA being 2 to 3% lower. That said, the group's revenue growth is still going to be strong at guidance between 11 to 13%. Considering that this is an anomalous, one-off impact in the financial year, this is not far off the average yearly growth rate of 16% in the last decade. Based on a discounted cash flow valuation, I believe that shares of Ashtead Group have a fair value at around £49.04 per share. But perhaps Ashtead Group just doesn't have enough value for you. Do I know of another stock opportunity? Well, yeah. Click here to learn about this really cheap stock.